Moving on to liquidity ratios. What are these? Well, what is liquidity? How liquid are you as a company, as an entity? How how quickly can you turn your assets into cash, right? Or how quickly can you pay down your debts, right? These will be tied in with solvency ratios. So with liquidity ratios, this involves net working capital, current ratio. Hey, working capital, look at it right there. Current ratio, quick ratio, acid test ratio. These are synonyms. They mean the same thing. We've got our cash ratio, operating cash flow ratio, and working capital turnover. Now, net working capital, I mean, it says net, right? Anytime you have net, it's something netted against something else, right? Net sales is netted against discounts or returns. Net income is revenues netted against expenses. So that's net working capital. Current ratio is the same as working capital, except we move this little subtraction sign into a division sign. So this is a ratio, whereas this tells you the dollar amount of how much cash you have. And ratios are wonderful because you can compare entities or companies of different sizes against each other, right? Because regardless of how much cash they have, you have or liabilities they have in dollars, ratios are percentages. And percentages don't lie. Percentages are great because you could compare a $10,000 small business versus a multi-billion-dollar company based on their ratios. The quick ratio or acid test ratio, again, how quickly can you turn your assets into cash? This takes current assets and removes inventory and prepaids, divides it by current liabilities. It's essentially a variation of the current ratio, but it's a little bit more conservative in the sense of, right, like we're not taking into account all current assets. We're taking into account, right, well, if you could sell all of your inventory today, I mean, wouldn't you do that? Isn't that the whole point of business? So yeah, it's under the assumption you can't sell all of your inventory today for cash. Prepaids, right? You're not going to get your prepaids back in terms of cash, so you can't take those into account. Another way of saying the formula is cash plus marketable securities. If it's a marketable security like a stock or a bond, you can sell that, right? You can just take that and sell that. Plus receivables. Now, hopefully you're going to collect these in the next 30 days or so. That's why we're included as well. Our cash ratio is trying to just basically get cash, right? Because we have current assets minus inventory minus prepaids and receivables. Or it's really just cash and marketable securities because, again, you can just sell your stocks and your bonds on the market right now, right today, if you want. Maybe you don't want to because they're a little bit lower price, but you still can. You have the option to do so. Whereas you're not going to collect all of this today. And another way to say it is the current ratio is taking into account your assets and liabilities that are going to come to term within a year. This quick ratio or acid test ratio, I would say this is much more right of a 30 or 60 day, and cash ratio is strictly okay today. What would be our current assets? So really just cash and securities, or bars of gold, anything you could just sell today that you could turn into cash. Cash for gold. Just getting throwbacks to those commercials. Operating cash flow ratio. This is just cash flow from operations divided by average current liabilities. I don't see this as much, but it's there. Definitely need to memorize these formulas. Working capital turnover is just sales divided by average working capital. How quickly are you essentially making your sales back based on your working capital? Great, wonderful. And with all these, we'll have some examples. We'll have lots to talk about in this wonderful section here. Net working capital. Let's dive into this a little bit more, as it is commonly asked about in the exam, even though it is, relatively speaking, a pretty simple formula. So an increase in the ratio of current assets to non-current assets would be indicative of an increasingly conservative working capital policy. Now let's read that again and think about this. An increase in the ratio of current assets to non-current assets, meaning we have more current assets. And I'm not going to call one more preferable than the other, but in terms of liquidity, current assets are more liquid. If we want to pay down debt today, if we want to if we want to pay down debt, if we want to buy something, an investment in cash, current assets win because you can use them today or within a year. But you know what I'm getting at here. So that is a little bit more conservative, right? It means you can pay down your debts. If you're getting more aggressive in your working capital policy, then you could buy more long-term assets under the assumption that they're going to increase in value or that they're going to produce you a lot of results. So this is due to a company maintaining more cash and liquid assets in order to cover liabilities with ease. Now, the downside to this is, well, you have more cash, and cash kind of just sits there and loses value as inflation happens. More conservative working capital policy combats high leverage. All of these points you could for sure see in a multiple choice question setting or something such as that. A working capital financing policy that subjects the firm to the greatest risk of being unable to meet the firm's maturing obligations is a policy that finances permanent current assets with short term debt. This situation is reminiscent of taking out margin or leverage in order to purchase securities. Additionally, short term debt is considered to be the most risky form of debt. Great way to remember that is credit cards, short term, usually get something like a 27% interest rate on those. So short term debt is risky as compared to long term. Think of mortgages as long term, those are a lot more secure. Now, I know there's the whole collateralization of it, and don't worry about that. I'm just giving you examples. So there we go. To understand the effect of any transaction, such as issuing stock, long term debt, think about journal entries. But Nick, this is BEC, not FAR. But hey, to that I say, there are journal entries. They exist, and this is accounting as a whole, so they are around. And its effect on current assets and current liabilities. Even plug in placeholder numbers to see the effect if you were to try using journal entries. And journal entries don't lie. I would never lie to you. I will always tell you the truth. Just me and journal entries, the only two in your life that will tell you the truth. Let's do an example of a liquidity ratio. Well, let's read the question first. How would we improve our quick ratio? Ooh, good question. So, this question like this, I would just write out your quick ratio, and here it is, right? Quick ratio. Anytime you see a ratio asked or you see a formula asked, I think that's a great indication that you should just write it out. I mean, I don't see why you wouldn't do that. The borrow company is applying for a loan in which the bank requires a quick ratio of at least 1. Now, this is an example of a debt covenant or a bank covenant for any of you who were wondering, which I'm sure was everyone. You're all quite curious. Faro's quick ratio is 0.8. So how would Faro improve its quick ratio? Now, your quick ratio is a bunch of assets over a bunch of liabilities. How do you improve the ratio? Well, you either increase the numerator or decrease the denominator. Now, this would be multiple choice question. This is the right answer out of them. I didn't include the wrong answers. So, but what would increase this? Well, okay, with what you have, I mean, yes, you could say make more sales and get more cash, right? You could sell a bunch of long-term assets and turn it to cash. That would be an option. Here, the option is selling obsolete inventory at a loss because that would give you cash. And you see, inventory is not included here in our quick ratio. So that's essentially like what I was saying. You take a long-term asset, convert it to cash, and that would increase this. I mean, you could also sell your long-term assets, pay down your current liabilities. There's a couple different, but that really all still revolves around getting cash for your long-term assets. Think about what's involved in the ratio and how you would go about it. Pretty logical, I like to say. I think it is. And I'm having a good time, and I hope you are as well. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.